Hello, and welcome to this webinar brought to you by Energy Risk in association with Enuit. I'm Stella Farington, Head of Content for Energy Risk, and I'm joined today by three panelists, who I'll introduce now. First, we have Federica Strumia, who's Head of Risk Analysis and Control at Neste, the Finnish oil and renewable products refiner. Next, we have Ganash Natarajan, who is Managing Director for Europe at Enuit, a commodities technology firm, and Gary Vasey, who is Managing Partner at ComTech Advisory. Welcome to all of you.
Thank you.
So the title for this discussion is Managing Commodity Risk in Turbulent Times, which could scarcely be more apt for 2020, I think you'll agree. This year has provided the energy industry with a series of unprecedented shocks. I think that word is sometimes overused, but not in this case. From the demand destruction caused by the global pandemic to enormous geopolitical risks. Firms have had to navigate extreme uncertainty, and the fact is that that's by no means over. In fact, looking out today, you could almost say that things are looking more uncertain than they were at the beginning of the year. Countries in Europe are grappling with the second wave of COVID-19, and lockdowns are sweeping across the continent. And when it comes to geopolitical uncertainty, it doesn't really come much bigger than today's situation where we're all waiting for the results of the US presidential elections, especially when two candidates have very different agendas, which would affect the energy industry very differently. So one thing that is certain, but unfortunately it's not a very good point, is the fact that energy firms' margins are very likely to remain under pressure and thin. And this leaves very little room for error when it comes to making business decisions. And it really renders energy risk management essential. Firms need to be able to monitor and measure the risks that they face in as near to real time as possible. And in this time of unprecedented change and huge volatility, many firms are now revisiting their risk policies and, for example, looking at the frequency with which they carry out stress tests or thinking about increasing their scenario analysis, for example. And all of this presents technological challenges as firms sort of review and change their day-to-day processes in order to better model their risks and hedge themselves effectively against this uncertain future. And underlying all of this is, of course, the matter of data. Data is everywhere now, but how useful is historical data in today's changing world? And how can firms make sure that the data they're using is the most useful as possible? So we'll be discussing all of these issues and more. If any viewers have at any time questions for our panelists, please feel free to type them into the Q&A box, and I'll address them to the panelists. And please do that just as they occur to you. Don't wait until the end. We'll ask questions as and when they crop up. So I wanted to kick off with getting an overview, a proper understanding of what risks it is that commodity firms might be most worried about now. So could I start by asking you this, Federica, first of all, as a risk manager at an energy firm, what concerns you most right now?
Yeah. Hello. Yes, as you said, Stella, this is an year of transition through unknown territory, because we have been seeing events which were not expected during this year, from, as you say, the pandemic through the geopolitical tensions and also continuing the discussions, which is getting more and more relevant and related to the climate change and the sustainability matters. So I would say that this year really will remain in the records as a year of transition. So transition means also transition risk, because what we have seen so far in the markets can be completely different from what we are going to see in the next 5 to 10 years. And especially what is important for us is to identify what will remain in the short term, in the current environment that we need to focus on more, and how do we need to change our attitude and our way of analyzing the information that we have? How do we need to review our experience as risk managers? Even long-date risk managers have seen things that they have never encountered before, probably. So I would say that the risks that are more important for us as energy companies, energy trading companies, are of course the increasing volatility that we have seen in the past months, and we still see today. We will still see in the next few weeks, probably today. I didn't check now, but with the elections, the post-elections in the US, I guess that the markets can also be affected by all these new informations that are coming in today. But anyway, what we have been doing in the past, doing VAR measurement, using these type of approaches that are the normal and the usual methods that we use for measuring market risk, they can also become a bit dangerous because using the past to predict the future and to understand the present with such a particular type of present, it can be quite dangerous. So we consider that we need more and more application of scenario analysis. Scenario analysis, for me, these are becoming more and more important. For me, they have always been important, because you cannot just stick to a normality when you just try to assess a risk. You need always to think in a bit more open matter. But the scenario analysis nowadays, in my opinion, are also needed to establish ideas on how the new normal should be in the future, not just to expect how extreme events or black swans will be, but how can the new normal become? Because we are not is not yet very well defined to us. We see that the current environment has very low margins, as you mentioned, and the demand destroy is also important. In the oil markets, we have experienced large contango structures, which companies have been taking advantage of. So this is the particular structure that you have in the market when you have the prompt price of the physical grades quite low, very low, and you can, the structure of your forward curve is in contango, so the market is more expensive in the future. So the curve, the spread compensating the cost of storage can profit enormously to companies. So this has been a big year for this type of trading place. But this is for the market price. So I think that this is the approach that we need to start using. So more stress scenarios and scenario analysis, less trusting the VAR numbers. Then another risk that companies are looking more in particular are cash risk, cash availability is very important, liquidity risk. And the way that we have noticed, and this year has become even faster, you have seen that investors have started shifting their interest and their kind of strategies for investment. Banks are getting out of the energy commodities business when it comes to oil, gas, coal. And so in companies like mine, this is another type of big concern. So if we had a big project, longer term project, probably this would be at risk of not being supported by banks or investors. So this is something that some companies need to take into account. Another one is the counterparty risk, because of course in this environment, knowing how our counterparties are exposed to the market and what are the type of risks that they are incurring in going to bankruptcy or not being able to pay is very important. And also the landscape is changing, because you have probably heard that many companies have been exiting the markets or re-entering in markets by changing their type of function and strategy. So we might also face changes in our customers and partners in the business. On the top, and then I have done, there are new risks which are of course emerging, that are primarily two risks that are very new for us. One is the climate risk, and broadly speaking, the other one is the sustainability risk. So how can these big physical events can impact our assets if we have assets, so big meteorological events, and how can the market where we trade be impacted. And sustainability risk is a bit broader concept where you can also consider all the ESG factors that we are more and more exposed to as companies.
Thank you. So you talk about some things there which are very short term and others there that are very long term. And it seems that there's almost a mixture of things like, as you said, contango in the market is a case of perhaps some opportunistic trading or reacting to that anyway. It needs to be done quickly. And others are much longer, things like looking at where you stand in terms of sustainability, climate risk. Have the events this year been big enough or introduced so much change that there's been times when you've had to actually sit down and look at your risk policies, look at your tools and techniques, and actually question whether they're the right ones?
Yeah, well, as you said, the risk policies need to be reviewed for the short-term application and for the longer-term application. Of course, when it comes to the ESG, sustainability elements and all these things, they will be probably analyzed more and more frequently, but in the medium term. It's not as urgent as analyzing our current models, the models that we are using to assess our risk. So I have noticed in our team, we are modifying our approach on how we interpret the relationships between the prices, how we read the information from the market, because you see, for example, we had an event where the WTI went negative, so it's out of every. How do you put these into your models? How do you put a negative price of a commodity into a model, or refinery margins getting negative? So you need to assess how much you can still lose from a market which is continuously moving down and getting depressed. So these are probably the most urgent parts. So it's not strictly the policy, but probably I would say the approach and the modelization are changing quite fast to adapt.
Yeah, thank you. Ganesh, could I bring you in here at this stage? Do the sort of things that Federica has been talking about resonate with you from what you're hearing from your customers, the type of risks that they are most concerned about? And also, what are you seeing firms striving to do as a result of the risks they're facing?
Absolutely. Thank you, Stella. And good to share the panelist view on this. I resonate a lot of thoughts which is shared by Federica, right? What we are hearing from the marketplace, mainly customers as well as the market participants, are the key question in everybody's mind is, how can you stay ahead of the curve, right? Risk is always all about, staying ahead of the curve. Given these turbulent times, we are talking about systematically, your earnings are impacted and there's a lot of volatility in the commodity markets. And people have started questioning, like, is my current modeling of, black swan events or anything like that? COVID has actually changed the way we all look at things, right? You can't model COVID. Nobody knew it before till the Q1 of 2020. So people are quickly questioning about how do I actually stay ahead of the curve, which means that there's a lot of synergies currently we are seeing in the marketplace where people are trying to map their commodity risk strategy and how are they conducting their business model, and then see how we can use technology and the data to stay ahead of the curve. So the relevance is tying all these three, right? Having a policy document somewhere picked up every 6 months doesn't actually give a chance anymore, right? So you have to really put that back into use almost and keep testing where you stand in this volatile condition. So I completely resonate what Federica shared with us on the initially, and credit definitely is one of the risks we are seeing. When we talk to some of our customers, some of the small and medium-sized players, they're talking about credit limits being a little bit squashed, which means like people have started asking for prepayments or provisional payments. So which means for you to be staying alive and liquid in the marketplace, you need to have a cash. At the same time, counterparty risk being extremely tightened up and then looked at with a strong lens, especially in the last 2 to 3 quarters. That's what I am hearing from the marketplace.
Yeah. Gary, could I bring you in here? What sort of trends are you seeing in terms of people managing these risks?
Yes, well, seeing all kinds of trends, and we look at it sort of in terms of what's driving CTRM software sales and interest. So we track the markets, what's going on. Plainly, everything's very volatile, and it's one of those eras where just about every kind of conceivable risk imaginable seems to be in play. And it's not just about trade margins and market risk, price risk. It's really about, because trade margins are down, it's about supply chain as well. And when you look at the supply chain for many commodities, it's very long, it's very complex. And it's open to all kinds of geopolitical risks. And we've seen many of those over the last couple of years, from trade sanctions and embargoes to COVID and other issues. And this impacts both sourcing and also demand. So what we're seeing is a lot of interest in digitalization, for example, a lot of interest in automation, trying to basically reduce some of the manual operational type risks in the supply chain. So just if your trade margins are quite small, then trying to make sure that you avoid delays in shipments or sub-quality shipments, that kind of thing, that are going to incur a penalty and maybe put your whole trade into a minus. Added to that, there are all kinds of other risks that people are interested in, of course, these days, things like legal risk and contract risk. I think foreign exchange risk is a huge one. Having ran a European power trader with multiple entities across different European countries, when you're trading a commodity that's in euros, for example, you're operating in Swiss francs, and you have multiple entities that need to be liquid and they're in local currency, then FX risk becomes a huge concern, and the treasury aspects of risk as well. So what we're really seeing is this sort of holistic view of risk emerging. People are becoming much more aware of all these different types of risks. They're looking at the entire supply chain in terms of how do we optimize, increase efficiency, automate, digitize. And I think, when you throw in climate sustainability, that's also a supply chain, because you're talking about basically traceability, brand equity. If we deliver a product that's substandard to the market and we can't track it back and we have more of that, we could damage our brand. So that's the kind of things we're seeing. And those are all certainly driving people's appetite for technology and for software.
Yeah, thank you. And the movement towards trying to manage these risks holistically, is there a trade-off? I guess I'm asking Gary and Federica this. Is there a trade-off between the, getting the very specialist knowledge in one market, and trying to fold that into and be measured with everything else? Is there a kind of holy grail that people are trying to reach, and is it realistic? Federica, what do you think about that? Is it a goal for the firm to manage risk holistically, as Gary was talking about?
First of all, for me, this is a very fascinating topic and way of analyzing risk, because everything should be nicely embedded, and the people should understand all the elements that are making the risk of a company. So I would not fix risk management by putting everything in different silos. So market risk get mixed to sustainability risk, to climate risk, geopolitical, and so on and so forth. Some risks historically are more embedded to each other. So if you think at the oil market, market price is strongly embedded with geopolitical risk, for example. But nowadays we are seeing more and more of these type of connections. And for instance, we are talking about sustainability. If you start looking at the price shape of these renewable energy, new renewable energy deals that we are seeing happening nowadays in the market, we see more and more diverse elements. So on the top of the classic price index, we can see elements of this price which come from sustainability elements like GHG emission measurement or price, carbon tax, price tag. And another type of example could be, if you think of the biodiesel, which is also becoming more and more popular. Many oil refineries are converting into biodiesel producers. You buy now in these refineries feedstock which are coming from the agricultural sector. most of the times, for example. And you are selling these biodiesels in markets which are still dominated by the fossil price indexes. So you are creating connections and relationship across commodities which were not existing before. And this is new markets which are creating and getting a shape. So because you have energy is using the food to produce biodiesel, energy is using the lands that are used for creating food to build, like for example, wind farms or solar panels. So there is a connection, and one price and one supply demand can drive the other. So I think that in substance, in this case, you can see the holistic term also going across different commodities. Plus the fact that merging all these quantitative and qualitative risks together is also an art. So you can need new tools, big data tools to analyze the relationship, to analyze and understand. And you also need expert people, I would say, because data without knowledge is remaining difficult to use. So it's so as risk managers, we need to be a bit to learn a bit about everything in this supply chain.
It's not only that correlations are changing, but completely new correlations are coming up.
Yes.
People are measuring things against other things that they may have never done before. And perhaps there could be correlations, that people have even thought of now, which will become more and more important. Actually, could I turn now to Ganash, please? Because I'd like to see what you're hearing from people in terms of their struggle to manage things holistically. Are you also picking up that that's something that companies are striving to do now?
Absolutely, right. So just to add on to what echo on to what Gary and Federica shared, right. So previously we used to see, you were trading in risk strategy, you were trading technology, your governance and risk and controls, and your risk analytics. And how are you being compliant with the market regulation? So if you look at a risk framework, people are looking at trading technology data as a silo, strategy as a silo, or used to be at least a silo, and how are you managing your governance and risk? As Federica said, right now, use of technology and data, and there is no more lines between looking at this in silo, right? When you're looking at a holistic risk management, you are looking at your market risk, your credit risk, your liquidity risk, your cash risk, and you are also really tying them back to how my technology is enabling it to take actions, right? You have a data, you have some business systems, and how can you actually use the data effectively to, again, back to my old point, to stay ahead of the curve. So we are seeing that trend too, in terms of people trying to connect all the dots, and the old way of looking at stress testing or VAR models at a 95% confidence level, it is still there. That's like one of the risk metrics, but people are actually making risk much more intrusive. What I mean by intrusive is like, hey, I'm going to make this decision, so let me actually be very prepared with the data, rather than actually make the decision and then look at the data in a post-mortem aspect. So we are actually seeing that proactive risk management, moving towards tying down all the, connecting all the dots. That seems to be the trend we are looking at. Some of our customers, we are working on the thing. They are looking at everything together, how I am transforming, where I am today, where I want to go tomorrow, what kind of data I have, how do I set me up so that I can actually manage all of these dots. That's the same trend what Gary and Federica were sharing.
Yes, yeah.
And also one thing, may I add? Yeah, one thing that I was thinking, you might also need to be very fast to react to changes.
That's true.
Your models need to be very agile in that sense. Yeah.
That's correct.
Yes. And actually, we spoke about this in the call, in our preparation call for this. Again, as you were talking about operational risk and the sort of push now towards more real-time position management. And you gave the example of perhaps if there's a delay to a ship, a shipment in a port. Could you elaborate a bit on?
Absolutely, right. So if you take a little bit, risk management, right? You don't need to worry about just energy or commodities or agriculture. The commonalities are same, right? So when you're looking at some of the bulk commodity customers who are trying to look at their, especially during this remote way of working, some of those folks who are actually managing the operational risk, especially when you're getting in material from a point A to point B, you are moving materials, or a vessel coming in from an Asia Pacific towards Europe with an LNG, or you're actually transporting metals, whatever that may be. it's very, very important because you have your P&L directly tied up with your logistical cost, right? If there is a delay in the shipment and you actually have, like, let's say something happened, we locked down the country, and then people just say, okay, Ganesh, your shipment is delayed by a 2-month cycle, right? So you got to be aware of it and then just say, okay, what is the cost of actually storing something, keeping in a warehouse or renting it out, or what's the cost of actually the downstream impact of the delay? So your operational cost and your logistics is as important and so integrated with your P&L on a regular basis, so that you want to keep watching those. It's not like your trading P&L or accounting P&L. There is a lot of trade support, and the operations become extremely important to look at their cost P&L associated with moving materials, right? That's a classic example of where where you have the synergy between the front, middle, and the traditional back office. And when risk comes and looks it together, they look at everything together. Your accounting P&L, your trading P&L, your operational P&L, where you stand on a daily basis. And the more data you have, and then you have some technologies and the business systems to actually give you that transparency, the faster, as Federica used a beautiful word, the faster agile you can make a decision. Hey, I can actually reroute, or I can park, or I can quickly call up somebody to say that, okay, park my rent for, I'm not going to store this from tomorrow. Shipment is delayed. So people are actually trying to find sources of money and sources of capital, even in the deal value chain, slowly and steadily. So for that, you need to use the data. That's one of the examples I can share with the audience.
Yeah, thank you. Gary, did you want to comment on this, or did you have anything else to add?
Yeah, just a real quick couple of things from a sort of technology perspective is just finishing off what Ganesh was talking about, is that we're obviously seeing a drive towards more event-driven risk management functionality in systems. So if something happens, then recalculate everything and alert the user to the fact that something has shifted. So if a shipment's going to be delayed, then recalculate everything, P&L or whatever, mark to market. And this event-driven type risk management we're beginning to see emerge quite strongly. But because the supply chain, and it's all about physical commodity, and the supply chain is becoming very much more important from this holistic risk perspective, geopolitical risks and operational risks, we're also seeing a trend from CTRM, which is about trade management and risk management, to more commodity management, which is more of a set of ERP functions around movements, inventory, chemical analyses, assays, quality measurements, all of this kind of thing. And so it's interesting for me as an analyst to sit back and see a company like Enuit, for example, moving from CTRM into more of a commodity management perspective in order to cater for the whole commodity supply chain from a physical perspective. And that's what they've done. They've moved into the commodity management side and developed a whole host of ERP type functionality within the solution to address this, Ganesh, right?
Right, you are spot on, right? The line between your traditional commodity trading or a commodity system towards your typical ERP or a financing system, it's blurring as we speak, every second, I have to say, right? So people are looking at, I would like to actually look at my, as I said, how can I link my trading portfolio to the charter of accounts? That's pretty much is the norm. And if you have a system or a data which can give you that, that's exactly the future of commodity management. That's what we are also heading as a business.
Yeah, thank you. I thought it might be interesting at this stage to talk about, as we're sort of drilling down into the technological side of things, to talk about, maybe what can and can't be done on a spreadsheet. I mean, for many years, people have talked about the perils of spreadsheets, and companies have tried to move away from them as much as possible. But I'm interested in how possible that is in all cases. And I'd like to ask Federica now, the spreadsheet is very useful at times, and yes, you can do an awful lot on it. And it is difficult to combine every part and have this holistic view of risk. Where do you stand on the use of spreadsheets in the energy industry as a whole?
Yeah, we are in a type of rehab from spreadsheets because after we moved to the ETRM softwares, we had kind of decided to get rid of the spreadsheets. But I have to say that sometimes a spreadsheet remains always useful to have as a kind of cross-check tool for the ETRM system, because ETRMs are very good, are incredibly powerful machines where you can do calculations and the power of storing data and analyzing and combining data is much more efficient than an Excel spreadsheet. But we still remain as normal users like me, we are still always remaining attached to the spreadsheets as a source of cross-check, let's say. And so the policy would be that you move away from the Excel because you need to have a strong system where the only source of truth, where everybody is entering information, analyzing and getting the result, being that hedging program, a mark-to-market or a financial statement. But at the end, I rarely see people who don't use spreadsheets nowadays, but they become less and less relevant. So they become like kind of what was the envelope maybe 50 years ago. So you do your calculation on the envelope, which is now a spreadsheet. But the ETRM systems, if I may, are also a bit limited by themselves, in the sense that without a powerful analytical tool that you can add on the top of the data that are stored in the ETRM system, we realized with the years that there is not much that you can do only using the ETRM system. So for me, the way I see is that this ETRM or CTRM system is very good as a database for storing information and elaborating some calculations. And then from a certain moment onwards, the analysis of the data is rather done with other tools, which are not Excel anymore, can be Microsoft BI or other tools that are used to really make the data manageable at standard user level, and are able to then create ad hoc reports for user and maybe add some more complexity also in the calculation. For example, if you need to do some particular scenario analysis or a complex risk metric calculation, maybe the ETRM is lacking a bit of flexibility in that area.
Yes, and that's interesting, and we'll come back to this again in a bit more detail later when we discuss other technologies like machine learning and artificial intelligence, which stands sort of slightly outside the core CTRM system, and probably explains some of what Gary was saying earlier about the move that or the space that Enuit is occupying, which is sort of broadening out from core CTRM. And Ganash, I wanted to put to you also the similar question on spreadsheets and just ask, what are you seeing in terms of customer use of them from the people that you chat with in the market?
I can take that one. So, Stella, this is I think Federica hit an interesting point, right? You're not going to replace Excel sheets, right? Excel sheets is more of you need to have them. You need to use them. You need to play with them. You need to do your own stuff, right? It's a kind of a myth to understand that a CTRM or ETRM system can replace your Excel sheet. So, but the key thing is the difference is, right? 10 years before or a decade ago, most of the ETRM systems in the market platforms or you see is very, very monolithic. What I mean by that is a little bit of a legacy technology, and it's more of a closed data model. What I mean by that is when you put in as a database, and then you will be finding it very, very hard to extract the data out of the system to make some insights. Right, but the key thing is your power of ETRM system or a CTRM system is basically, are you able to model all your complex contracts in pricing formulas to manage your risk effectively within the system? That's a question number one. Because if you're able to look at only the vanilla contracts and then all your complex contract, which carries the most amount of risk, is kept outside the Excel sheet, then there is no point, actually. You lose the value of the system, right? The key thing is, are you able to model everything with a flexible pricing formula, whatever commodity you're trading? And then are you able to model the risk? And then once you're able to model the risk front to back, are you able to extract data, as Federica pointed out, unless you don't slap on a pivot reporting or a power filter capabilities for me to make sense of data. And that kind of capabilities exist within certain products like Enuit, whereas you convert the data directly into insights. If you don't have that flexibility to pull the data out from a very closed data model, as Federica said, it just becomes a transactional data. You can't turn them into insights to take some actions proactively, right? The challenge is, how do you choose certain things to make sure that the data is useful on a day-to-day basis? So I'm definitely not going to say that Excel will be replaced, but the key thing is, if a system can give a lot more data output back into Excel for further analytics, that's great. For that, you need to have an open data model as a platform. That's my view on that.
Yeah, thank you. We're getting quite a few questions in now, so I think now might be a good time to put some of these to you. The first one that's come in is talking about the topic that we've all covered, that we've all mentioned already, especially Federica in the beginning when you were talking about the importance of cash flow and credit limits. And the question is tightening of credit limits an important tool for energy players in the current climate? Is that something that's happened a lot in 2020? Do you want to tackle that one first, Federica?
Yes, well, I'm not really a credit risk analyst, so I don't know much about that, but definitely I know that during this year, my traders had many more issues with the credit desk to get certain counterparties approved or getting the credit limits to trade with them. So I saw that there have been, in the current climate, more analysis performed by the credit teams concerning the different counterparties. Having said that, I think that they have not revolutionized their methodology. Although in future, this is something that I see more as a development for the medium and long term. Maybe there will be new tools like also using artificial intelligence to go through the different financial statements to understand how a certain counterparty can be or not exposed to certain areas, because it's become more and more complicated to do an assessment of counterparties. So for the short term, I would say we are more careful, more attentive, but not completely revolutionize the approach.
Yeah,
but for the longer term, yes.
And this is another question which is also looking at liquidity risk and credit risk. And the question is, with increasing, I think this might be a good one for Ganash, with increasing cash risk, small and medium-sized commodity companies face bankruptcy and difficulties in trading. This will reduce the liquidity and adversely affect the efficiency and price discovery, which is bad for commodity markets. Also, the commodity market may trend towards an oligopoly, which is bad. How to prevent?
Okay, I think it's a very interesting question, right? Mm-hmm. So I do see the couple of things which is happening, not just because of the code. Overall, it's always commodity companies are looking for value enhancement, right? At any point of time, you are always continuously look for how do you increase your value. Is the credit and the cash being tight in the marketplace? Yes, right. Is there a direct link between, because of the liquidity issues, is people are going bankrupt? I think there is a certain element of truth in it, right? But there is also an opportunity in this case, right? You can actually see that's where the post-trade risk become pre-trade risk. During this COVID time, if you look in the market, there is a lot of direct market access. So there are some oil brokers trying to actually round up a lot more tiny oil brokerage firms and then provide them the route to market access. So there is not more of an, I would not use the word oligopoly, but there is a lot of DMA kind of an offering coming into prison. So basically, you set your limits, you manage actively your DMA provider or DMA counterparts limits very actively in the oil space. That's exactly what happened after the negative prices, right? Not everybody who was trading oil just stopped trading oil. So people started, finding actually some value of moving towards direct market access or try to work with somebody else who can actually give them technology access as well as the DMA access, so that let's say you're not able to actually become a clearing member in an ICE or an exchange. Find somebody who is, and then try to work with them in a DMA arrangement. So there is a change, or there is a shift towards a DMA or direct market access kind of capabilities, which is actually a healthier thing because it actually pushes back the liquidity into the market participants, right? If I cannot stand alone, but if I'm able to join hands with somebody else and able to provide a DMA access or be a part of a DMA member, it is actually going to drive the liquidity and a little bit more transaction and then keep a lot of things afloat. That's one of the ways I see things, right? I'm not qualified to comment. Is there's going to be a lot of M&As and acquisitions? I think in my honest, humble view is without COVID, that was already happening in the marketplace. It will continue to happen. Maybe this is another trigger, right? But it doesn't become really bad in a sense. It may open up a lot of opportunities. That's my take on that one, Stella.
Okay,
I agree. Yes.
And there's another question come in, and this is for Federica. This is really interesting. Do you think our models are still valid? We usually don't model black swan events, but in the last 12 years, there's been 3 of them. How can we make a modelization of midterm? So I guess that's asking, how do we model things in the medium term?
Yeah. My first answer would be don't trust value at risk and don't take that numbers as granted, but use them, because every analysis and every risk analysis that you might do can bring you some ideas, doubts, questions. So everything is useful if it is used carefully and with the good knowledge of the tool that you are using. So in the past, we could use value at risk because we were living in a world where the normal was quite happening every time. So in the last years, as you mentioned, that we had 3 big crises, and so this must have taught us that we need to look more and more at scenario analysis. For me, this is the answer, and I have been, in my experience, in our teams, we have been always doing VAR together with stress, because they are kind of compensating to each other in terms of how do you view the future market. So quantitative models that look backward cannot be used to predict events that have never happened. So I think that you should, as an analyst, get more and more in your day-to-day routine into thinking out of the box by remaining pragmatic and analytical, by discussing with the business, because the business can also enlighten you on what can be possible, although extreme, and what is completely absurd. So you can eliminate already scenarios from your desk, but keep it open in the sense that stress testing is what you need to master, even more than VAR, in my opinion.
Yeah. Okay. Thank you. Now we have another question here on artificial intelligence, which was actually something we were going to move on to next. The question is, how can artificial intelligence or other new technologies help in order to be faster in making decisions? So I think if we could sort of weave that into the general topic we were going to talk about around harnessing new technologies such as artificial intelligence and machine learning. Could we start with Federica, and then we'll go to Gary and Ganesh for your views on this. Federica, could you tell us your how much has Neste done so far with artificial intelligence and machine learning? Have you discovered functions that could be easily replaced by robots, as it were? What functions and what areas are sort of most promising or most ripe for the application of these new technologies?
As per artificial intelligence, I consider 2 areas. One is the robotization, so the robotics. That means that you can model and have a robot or a machine repeat all the steps that a human is doing, because these steps can be repeated, so they are always the same. So this is one area where the artificial intelligence can help. Of course, these tasks we have tried. Yes, the answer is yes. We tried in the middle office and risk, and then we realized that we were not able to find a repeatable action in our day-to-day routine, because every day we do things in a slightly different way. Every deal is different. Every number that we publish requires our own elaboration and interpretation. So it was very hard to find tasks that we were repeating daily on the same way and for a good reason. What we found is that we do a lot of manual work that we repeat in the same day, but not for good reason. That should be eliminated from our desk, not done or performed by a robot. So for me, is more finding out efficiencies in our way of working and eliminating the non-necessary work. On the robotic side, in other desks, in other teams, I have seen that, for example, back office have been using that quite a bit because they probably have some repetitive tasks that they could model. But yeah, this is all I have as experience from my side. Then the other part, which is also very interesting, is using like neural network to do analysis of data analysis. So we have this big data, which we don't know how to put in relationship and how to find new correlations and new relationship. So using neural network and artificial pattern recognition and all these things can be helpful to help analysts to find new correlations, new patterns. But even in this case, I have done some work with neural networks in the past because I have a scientific background, and I can say that in some areas like science, neuroscience, mathematics, physics, neural network can be used in an efficient way because in science, things repeat through rules, and these rules are always the same. When you try to use neural networks to interpret data which are coming from trading, human activity, decisions which are made by humans, it's a bit more tricky and it is a bit more dangerous. So a neural network needs to be trained on a certain set of data to learn certain patterns and to predict what can happen tomorrow. But it's very dependent on the data that you feed, on the way you decide which variables you feed your neural network, and also depends in how you interpret the outcome. Neural network can be biased because you can decide to put some variables instead of other variables. So these are all the possible gaps or things that people need to be careful in when using this type of artificial intelligence. Mm-hmm. Having said that, it's a very strong tool because it allows you to analyze and to run over million and million of data that in other ways people would not be able to look at. Mm-hmm. And then another part which is for me very important and fascinating and has a lot of potential application is the blockchain technology. So for me, this remains the most elegant and impressive technology that I have seen in the past few years, and could be probably linked also to CTRM systems also to some extent.
Okay, thank you. Gary, could I ask you, you've got extensive and very long experience following the trends in commodity technology. What are your thoughts on, where artificial intelligence and machine learning could be the most useful?
We actually did a research project on disruptive technologies in commodities a couple of years ago, and it was quite interesting because although blockchain was the big thing from a media perspective, most people we talked to felt that blockchain was still 5+ years away. And the emphasis was definitely on artificial intelligence, machine learning, automation, robotics, that kind of thing. And indeed, we are beginning to see all kinds of application from, obviously in real-time power markets, actual robots trading, that kind of thing. But we're seeing lots of application and use cases in things like reconciling invoices, or automating confirmations, even automating transportation routes, taking into consideration the facility of the port and the cargo that's being carried and how it's being carried. And even in the case of Cargill, I think a wonderful example, listening to fish feeding in order to figure out when to harvest them. So we are actually seeing a great deal of application of artificial intelligence in the industry. And I think that from a trading perspective, we're probably going to see traders gradually, maybe not gradually, maybe quite rapidly, become more analyst, programmer type people rather than Rolodex, well-connected industry people, because that's where we're beginning to see a lot of application for that kind of thing. But again, just to emphasize the supply chain and back to automation, we're also seeing a lot of workflow and approval type implementations, trying to make sure that operational risks are taken care of. And in that workflow, there are often opportunities for, as you said there, repetitive tasks to be automated. And I think that's where we're going to see an awful lot. On the blockchain side, we're beginning to see blockchain emerge now. And I think one thing about blockchain that I find intriguing is that it's really brought to focus this idea of collaboration, because blockchain essentially is about a collaborative environment. And so blockchain is not just a technology, but I think it's a business shift. It's a shift towards increased collaboration in the industry and recognizing that efficiency and security and confidence can be gained by working collaboratively.
Yes, very nicely said, yeah.
Ganesh, do you have anything to add there?
No, I think Gary and Federica kind of summed up beautifully, right? There are a few things I would like to pick that up, I would just say enhance on that part, right? AI or machine learning or RPA, robotic process automation, or blockchain, right? These are all definitely technologies, right? The one thing which, as Gary said, which is or Federica said, is resonant going to be, what is your business use case in terms of what are you trying to solve, right? Technology is a tool, right? There are some few oil refiners right after the negative crash in April. A lot of places people have started looking at AI for price forecasting, right? And people are looking at AI for asset valuations. We see that a lot in energy and the oil space, where AI being already used as a typical use case to value their assets, as well as looking at the price forecasting very intelligently. RPA, in my opinion, it's more of an operation efficiency. Definitely, like, there are some power trading which can be automated. You can call that as an RPA. But let's say, for an example, you are a multi-commodity trading organization. You have a disparate array of systems. But if your head office is looking for some aggregated risk report, given the assumption that you do not have a big data warehouse which pulls in all the trades, right? RPA is a base tool. So there are some standard platforms in the marketplace where you can go back and scrap the data, put them in an Excel sheet, where you can actually eliminate hundreds and hundreds of man hours to actually produce that report as an interim solution. So there are some real use cases where you can actually link up RPA, robotic process automation, towards your people efficiency, as well as you can actually look at, okay, I would like to value my assets more intelligently. I want more data points, right? My trend is anybody who is in a commodity management or commodity trading business has got one goal, right? Gary talked about at the start of the discussion about digitalization. One of the things we are always continue to do is how I'm going to serve my customers, right? Even a commodity trading company, you have your own customers, you have your own suppliers, right? Using data and using technology to create an absolute transparency to engage your suppliers and customers, for me, is almost like a digital blueprint, right? You can actually slap on an AI, or you can slap on a machine learning, or you can slap on a blockchain to do this. But end of the day, you are almost trying to engage your own customers and your own suppliers to manage your day-to-day operations, right? How effectively you do use it drives your use case, actually. So I completely resonated with what Federica and Gary talked about.
Okay. So you talked about data there, and I wanted to come to our sort of final topic now on data. We have got some more questions still, and I will try and get back to at least one of them at the end. I believe that we can still answer questions after the webinar. So if we don't get to you now, we will attempt to afterwards. So moving on to data and the fact that historical data, perhaps more now than ever, is not necessarily a good indication of the future. Federica, could you talk around the sort of discussions you might be having around data at the moment? Is this the sort of type of conversation you're having where you're looking at past data and saying, wow, is it enough use for us? And what do you do about that?
Yeah, well, it's true that the weight that some elements that are derived from the past, from the historical analysis, need to be reconsidered at the light of the current environment. And we are learning by doing and by discussing with business, because data by themselves in this moment are not sufficient to understand what's happening. So we are now starting collecting several months of COVID experiences. So we have been already collecting a few months of historical data in an environment which is a bit particular. So we might have an idea about new relationships and new effect of what the demand destruction that we have seen in many areas in our commodities have created, and what type of liquidity issues, volatility spikes, and also new relationship, as we mentioned. Yeah, I think that we see that mainly our traders are struggling with lack of liquidity in the market. So the data are probably suffering because of that, because brokers can publish their curves or their prices or their information with less available elements than in the past. Yeah, this is one thing. And then one other aspect is that you need to be very on the top of these changes. As soon as you see something that is moving a price curve which is not behaving like it was behaving in the past, you need to start understanding and try to interpret these numbers and understand how the elements that are constituting that price are moving. I can give you an example which comes from hedging side. So we have seen that historically aviation companies have been always hedging their jet kerosene exposure in the market on the long term. So companies like British Airways, for example, who are naturally always been short jet for their airplanes, have been always hedged themselves against the increase of jet price by buying swaps of jets on the longer term. So what happened now? Now that everything has collapsed on the jet industry, these companies, which have been on one side had big hedging programs in the future, so they had hedged the calendar years following this year, following year. So they had bought a lot of jet swaps. With the jet swaps falling down, they have lost millions and billions. British Airways have lost $1.9 billion in this hedging activity because they have hedged something that didn't realize, because the demand was cancelled. The flights were not used. So they were not hedged wrongly, and they didn't have the physical exposure. So in this case, when you see that the jet price moves down, you have to immediately review what your exposure is to that market. So if you are an aviation company, if you are a jet user, you need to immediately revisit your policy of hedging and say, okay, come on, we have hedged the full year, we have to get out as soon as possible. And this is something that the British Airways, for example, recognized they didn't do immediately. So this is the type of data analysis that people should do more proactively. So being faster in changing the approach and changing also the regulation in this case, because these are hedging policies which are probably put in the stones, and it's extremely difficult to get them changed. But data talk a lot. You need to understand what they say.
Yes. Okay. Thank you. We're almost out of time now. I just wondered if Ganesh, if you wanted to add anything to that. Presumably, the important thing with data is not only selecting, the data that you need, but being able to use it properly, being able to make sure that it's cleaned and usable and compatible with everything else that you're doing. Was there anything you wanted to add along those lines?
No, I think Federica covered a lot more things, right? I would just say, when you're looking at the data, right, always look at a system or a platform or a way to bring the data out and in a very meaningful format. So first of all, whatever that may be, right? It may be a third-party solution, or you are actually trying to build an in-house solution. Always look for something like, okay, if the data gets in there, how do I efficiently get it out, right? Which means, like, standardized design, and an open data model, right? And always think about how I'm going to use the data in terms of reporting upfront rather than actually worry about the reporting and analytics at a later stage. So if you design an end in mind, you start putting the building blocks of data together, you'll be able to absolutely extract the data with whatever systems you have. And once you're able to extract the data meaningfully, it is very, very easy to apply all of these new technologies to convert the data into insights. For that, the foundation has to be much stronger. So you cannot have a closed data model or a closed data system chosen or implemented, and then try to automate that, and then try to apply these brand new technologies, shiny technologies on top of it. It won't just work, right? Yeah. That's my only takeaway as a technologist. So.
Okay, thank you. Well, I can't quite believe it, but we're out of time now. So I would just like to say thank you so much to the three panelists for such an interesting discussion and for taking the time out of your day to provide us with your insights. So Federica, Ganesh and Gary, thank you very much for your time and expertise. And it's been a pleasure listening to you today. And just remains for me to say thank you to everyone who tuned in. And I'm sorry that we didn't get round to everyone's questions. But as I said, we will try to address what we can. And thank you very much for listening and watching.
Thank you so much, Stella. Thanks for the time.